Hello and welcome to our December webinar here for personal wealth strategies to round out the year. 2025 is already coming to an end, and it's hard to believe that it's almost over. But we have one more webinar here for you, and 'tis the season to be speaking of charitable giving. Yesterday, the Tuesday after the Thanksgiving season, is known as Giving Tuesday. And so today we're going to be talking about some giving strategies. So perhaps you gave on Giving Tuesday and you were saying, wow, I wish I had this webinar before. So I gave in a more tax efficient way, because that's what we're going to be talking about. So yes, it's great to be charitable, but the question is, can that charitable contribution help you save on taxes? Because it's no guarantee that just because you give, you are going to get a tax benefit for it. That's not a guarantee. There's some different strategies and different things that you can do to maximize the tax benefits that you get on your charitable giving. And that's what we're going to be talking about today with the help of our lovely team here. So myself, Justin Rice, we have David Balin, founder of Personal Wealth Strategies, and we've got Ian Mindis, CFP, registered Social Security analyst, expert on a lot of things. And so we're going to be talking and diving in today about charitable giving. So I'm going to be sharing the slides. As I'm sharing these slides, gentlemen, anything you'd like to add to the introduction?
So I'll throw out there that one of the slogans when you talk about philanthropy is doing well by doing good. And I looked up in the preparation for today's meeting where that saying came from. And I did not know this. It was actually popularized by Ben Franklin. And Ben Franklin was one of our first financial planners when he suggested that a penny saved is a penny earned, having the vision to know 250 years later that the penny would be eliminated and the only pennies that you could save would be the ones that you still have.
Well, maybe those pennies are actually worth more, so you might want to save those pennies if you find them, since they're not making them anymore.
They're collector items.
The title is here, Planned Giving and the Tax Efficient Philanthropy. And so some people take the approach that, I'm just doing this giving to be charitable. I don't really care what benefits are on the tax side of things. And I would say that potentially is a little bit short-sighted, because what you're paying additionally in taxes due to some of the inefficiencies, you could actually be giving even more to the charities that you care about. So unless you're a big fan of Uncle Sam and the charity that they run, that you have to give to every year, that you're forced to give to every year in the form of taxes, perhaps you do want to pay attention so that you can more support the charities that you actually do want to take. And so here's our roadmap for today. Number one, we're going to be starting off talking about the new rules of charitable giving. And so we had a new tax law, the One Big Beautiful Bill Act. I didn't come up with the name, that's the real name of the law, that made some changes to how charitable giving is going down starting in 2026. So we're still under the 2025 rules, obviously, for this year. There's a shift of rules going into 2026. And so what are those changes and what do you need to know about them? Then we're going to go through some simple giving tools, some qualified charitable distributions, donor advised funds, and we'll leave you guessing on what that actually says there, a little cliffhanger. Then three, we're going to dive into a little bit more of advanced strategies. So strategies that, not everybody is going to take advantage of, but if you're in that higher, portion of wealth, that those strategies come into play. Or if you have, very large amounts of taxable income that come into one year, there's some strategies that could be utilized there. And then overall, like throughout, real world examples and like practical implementation of making it work, with the final of making, of announcing what, I, and along with Personal Wealth Strategies, is doing from a charitable perspective as well. And if you would like to join us there. So new rules starting in 2026, what do you need to know? Well, there's a couple of key changes. The first thing is good news for non-itemizers. Now, what the heck does that mean? So if you've taken the standard deduction in, historically speaking, and by the way, most people take the standard deduction, because one of the things that people confuse is that they give money, they give it to their tax preparer, and they assume that they're getting some type of benefit for their charitable deductions. That makes sense. Except if you take the standard deduction, you don't, because in order to get a charitable benefit for your taxes, you have to itemize. Now, when the Tax Cuts and Jobs Act back in 2018 passed, what happened there is they raised the level of the standard deduction. So they pretty much doubled the amount of the standard deduction and at the same time reduced some of the other deductions that would go into the itemization, which pushed 90+% of people into the standard deduction, meaning that even if you gave charitably, you didn't get a benefit from a tax perspective. If you just gave cash, to your church donation, the Red Cross, any donation that you would want to give to, you didn't get a tax benefit for it unless you reach the threshold of itemizing. Not this year, but starting next year, you are going to want to maintain those receipts, even if you're just taking the standard deduction, because we have this new what we'll call a below the line deduction. And we'll go into what that actually means. But the key is you don't actually need to itemize in order to get the deduction. So up to $1,000 if you are single, married filing jointly, $2,000 annually of a benefit that you can take even without itemizing. David or Ian, anything to add on that front from non-itemizers, standard deduction conversation?
David, I'll let you go first if you have anything.
Okay, well, to me, the action item here is if you have not been able to qualify for a charitable contribution in the past because you were a non-itemizer, here's the action step. Starting in 2026, start saving receipts, cancel checks, credit card statements. Because if you go to your accountant, your tax preparer in April of 2027, and he or she says to you, did you have any charitable contributions? And you go, I think I did. You do not get a benefit for I think I did. You get benefits for receipts. So start saving cancel checks and receipts if you haven't done so in the past.
Yeah, and to piggyback off that, David, that's exactly what I was going to say is to start saving those receipts because for the longest time, you weren't getting, especially if you were taking the standard deduction, any sort of additional deduction for any charitable contributions. So making sure you save everything and making sure you're just aware this is kind of like a public service announcement that, this is now going to be available starting next year.
Yeah. And here's what I'll call a non-action item, meaning that if you take the standard deduction and let's say you have $1,000 that you want to give to your favorite charity on Christmas, well, maybe it might make sense to wait about 6 days and give it on January 1st instead of December 25th, assuming that that works with your timing. And by delaying that 6 days, it takes that $1,000 that you wouldn't get a tax benefit for, and then you could get a tax benefit for in 2026. And so one of the non-action items is if you're in the standard deduction and you don't care necessarily about the timing of the deduction, whether they get it or what timing of the gift to the charity, whether they get it in, end of December or early January, doesn't make a difference to you, then it probably would make sense to delay it a couple of days into the new year so that you then can take a benefit for it. But what if you do itemize? Well, the rules are changing the game in 2026 as well. So if you do itemize in 2026, there's two key changes. One of them I list here is there's a new 0.5% of adjusted gross income floor that you have to surpass in order to start the deductibility on your charitable contributions when you itemize. What's that mean? Example, $200,000 adjusted gross income. So your first $1,000 that you give, you can't take a deduction for if you itemize. And so if you're itemizing and you have that $1,000 and you were going to wait till the new year and have a new year gift, you probably want to pull that forward into 2025 and make it a December gift because there's no floor this year on itemizing your taxes. So it will just get added to your other itemized deductions. And therefore, you would be able to take the benefit for it. Whereas if you wait until the calendar turns in 2026, only gifts in excess of that floor get deducted. And then here's the other and that's not on this slide, is that typically speaking, and in 2025 this is the case, you get a dollar for dollar reduction in your taxable income when you have an itemized deduction. Starting in 2026, and this affects all itemized deductions, not just charitable giving. Charitable giving is one of them. But if you're in the highest tax bracket, the 37% tax bracket, then you only get a 35% deduction, a maximum on your itemized deductions, meaning there's an extra 2% multiple that you would then have to pay additionally, even though you're taking the itemized deduction. And so for those reasons, if you are a higher income and you're taking an itemized deductions already, it may make sense to accelerate your charitable contributions into this year, either gifting directly to the charities or doing some of the other strategies that we're talking about, like a donor advised funds, et cetera, that we're going to go into later. Gentlemen, any final on this slide before we move on to the next topic?
I'm just going to put a little disclosure here in that a number of the examples that we might give, we may be mentioning a number that sounds like a big number to you. Justin talked about a $1,000 gift at Christmas time. We're going to talk about giving a house away later on. Don't be thrown by the big numbers. The strategies that we're talking about, the concepts of donation, include gifts of $10, of $100. Don't be intimidated. If you think about a person who's in, say, the 22% tax bracket for federal taxes, if you make a $100 donation to a local cause, by getting this deduction, if you're non-itemized, so this deduction of $1,000 or $2,000 if you're married, that $100 saving that receipt is worth $22 because you're in the 22% bracket. You're going to save $22 on a $100 donation. For $22, it's worth saving the receipt. Yeah, if you donate $1,000, that becomes $220. But think small, think large, think all the different elements here, and don't be thrown by what may appear to be big numbers.
There we go. So let's talk a little bit about the QCD, Qualified Charitable Distribution. Ian, if you could take this, like, what the heck are these? We got some key points on the slide here. Like, why would somebody want to do a qualified charitable distribution? Who does it even apply for?
Yeah, so let me start at the title because I love it. A retiree's secret weapon, because it's not really a secret. It's pretty definitive in the tax code. It's pretty definitive in what we do and what, many retirees do. But it might just be a little bit confusing. That's why it might seem like some sort of secret only for the very wealthy. So with a qualified charitable distribution, it works very similarly to just a regular distribution, except the IRA distribution not going to the actual person, it's going to the charity of their choice. Now, one important thing to note is it has to be from what's called a qualified account. So think IRA, and we're going to use IRAs for the remainder of this kind of conversation, but you have to be at least over 70 and a half. Why now 70 and a half? Well, for those who can remember from just a short few years ago, that used to be the required minimum distribution age. That was until Secure Act in 2020 came and moved that up to 72 and then eventually got moved up to 73. But you have to be 70 and a half to be able to make a qualified charitable distributions. Now, those go directly from the IRA to the charity. And there is a dollar limit in the amount that you can do. So in 2025, that limit is $108,000. And then that's going to increase to $111,000 in 2026. Now, there's no limit to the amount of charities you can donate with as long as it's within, that dollar maximum amount. So in theory, I guess for 2025, you could do 108,000 different charities, but I would not recommend that. That's a lot to keep track of, and I don't even know if there's that amount of charities in the world. But a really great thing about the qualified charitable distribution is that's not going to count as taxable income to you because it's going directly from the IRA directly to the charity. So you're not taking the money, so you're not going to pay the taxes. The money's going to the charity. The charity's not going to pay taxes because it's a charity. So it's a win-win for yourself. It's a win for the charity because they're receiving money. The only one who's going to lose out is, of course, Uncle Sam because they're not going to get their taxes. And why it's really a secret weapon, why it's a weapon, is because this can count towards and satisfy your required minimum distribution, your RMD. So for those who were born prior to 1960, the age is 73. And for those who are going to be born after 1960, eventually it's going to be age 75. So at that time, the IRS says a certain amount has to come out of your IRA, whatever the dollar figure is. Let's just say for our example, Mary on the side here, she has a required minimum distribution of $10,000. She says, well, you know what? I don't necessarily need that money. Why don't I donate it? So she does a qualified charitable distribution of $10,000. She's satisfied her RMD, and there's no taxes owed on anyone's part. And some little additional benefits that lower adjusted gross income that can also help reduce Medicare premiums and even phase out of some Social Security taxation if you're within those parameters. So the qualified charitable distribution, it's one of the more simple kind of strategies for those trying to donate and save some money on their tax bill, but also just something to make sure that you're aware of when you come to that age for your RMD as well, because it will satisfy that. Dave, Justin, anything you want to add to that? Any fun things?
A lot of fun things. So one thing I do want to emphasize is that it must be an IRA. So you cannot do a qualified charitable distribution from a 401k, 403b, like it must come from an IRA. So what you would need to do in order to qualify for it is do a rollover from your 401k, 403b into an IRA, and then that would allow you to open up the ability to do the qualified charitable distributions. Can't be done from other qualified plans. Number two, it must be direct to a charity. So you can't use something like, going into a donor advised fund or a foundation, like it has to be direct to the charity. So you can't, do it into some other vehicle that you would then gift at a later time. Like it must be direct at that period. And then don't miss the magic of it lowering AGI, because in fact, a qualified charitable distribution doesn't makes the income just disappear from your tax return. So it reduces that adjusted gross income. And so if you're close to either the Medicare surcharge, where you would get an increase in your Medicare costs, or you have your Social Security that's getting phased into taxation, and if you give $1,000, if you're in the 20 or 12% tax bracket, let's say, even shrinking it more, you may be like, what's the biggest benefit? I give, $100, I save $12. But if you're in that Social Security tax torpedo, yes, you're in the 12% bracket, but your Social Security is getting phased into taxation too. So you're really actually, in tax rate, are closer to 20%, actually a little bit above 20% taxation. So you're actually saving a bunch more. And so what we're talking about here is to not necessarily, if you don't want to, give more. But let's say you are giving $1,000 to your church throughout the year in like the little baskets. Rather than doing that, gift it out directly out of your qualified charitable distribution and you get the tax benefit. Whereas if you do it the current way, you're not. So we're not necessarily talking about you having to give more. We're just talking about you doing things differently. David, anything else additional to add here?
Yeah, one of the questions that we do get about qualified charitable distributions is about the mechanics. We'll get clients who will say, well, I give to the American Cancer Society every year, maybe on Giving Tuesday. And like, how am I going to do that? If I do a qualified charitable distribution, how will they know it came from me? Or how will I know how the logistics work? Well, let's start with that almost every 501c3 organization, and that's the filing that the charity has to go through to be considered to be a charitable organization by the IRS. Every organization has a development office, and that development office knows all about qualified charitable distributions because you're not the first one. And if you call the church, if you call the synagogue, if you call the ASPCA and say, I'm a retiree and I want to donate money to you through a qualified charitable distribution, they'll say, thank you. And then they will walk you through the procedure because they all know what you're doing. Your local church, people say, well, I have to put money into the basket. Well, that's because tradition teaches us that when the basket comes, we put money into the basket. But the church would be very happy to take your qualified charitable distribution. And they will walk you through how to get the credit, how to get the recognition. So there's ways to do it. It is a little bit different. It's not as easy as writing a check and then mailing it, putting it in the mail, or going to the website and putting it right in. But if you take this extra step, it pays very well.
All right.
Pays you because you don't have table sand.
Yes, and we have a beautiful question in the chat. And then Ian, I also want to share a little bit of magic on the 1099 form that
Mm.
we were talking about before. But first, we're going to answer this question because it's super relevant. Can you do the QCD from a beneficiary IRA and have it satisfy the RMD? Anybody want to take
Well,
that answer?
yep. The beautiful thing is it's a pretty simple question. The answer is yes. Required minimum distribution from an inherited IRA, beneficiary IRA, uh, can count towards your RMD from that account as well. Now, the RMD rules with inherited IRAs, those are too complex for what we're going to be talking about right now, but the simple answer is yes, you can do that.
Yes, and but you still yourself have to be over 70 and a half to take
Correct.
advantage of that. So you can't do it if you're, 50 and you have an inherited IRA. But if you're 70 and a half and you have an RMD from a beneficiary IRA, you can do it from a beneficiary IRA or your own IRA at that point in time. Yep. And then Ian, because one of the problems with the QCD that we've seen in practice is that we do this planning with the client, we gift it out to the charity, everybody's happy, the charity's happy, the client's happy because they think they're going to get a tax deduction, and then we get their tax return the next year, and then I notice on the tax return it wasn't reported correctly. Because historically speaking, the 1099, which is the tax form that you get when you take a distribution from your retirement account, doesn't factor in the qualified charitable distribution, meaning that if you take out 10,000, it's going to report 10,000. It doesn't say 8,000 went to you, 2,000 went to a charity. And so you could do the QCDs, but if you don't tell your tax preparer, at least historically, you wouldn't get the benefit anyway. We found money on clients' returns this way for the tax preparer not reporting the qualified charitable distributions correctly, but that could be a way of the past. Ian, what's the latest update there?
Yeah, so for much of this year there was a rumor going around that qualified charitable distributions were going to be reported on the 1099, separated out so that it would be easy for tax preparers to report them correctly on tax returns. Well, that rumor is now officially true. With the IRS guidelines for 2026 being released. So it is going to be code Y within box 7 is where they're going to separate out those qualified charitable distributions. And that is effective for this tax year for 2025. So the 1099s that are coming out for 2026, if you did take a qualified charitable distribution, it should be separated out correctly on the 1099. Now, if it's not, then that's something you'll have to deal with the specific company that issued the 1099. But it should be starting for this year and moving forward, which is going to be helpful for everybody.
Good news. All right, so this strategy now, so QCDs, like if you're not 70 and a half, you're like, well, what the heck, what can I do? Well, here's something you can do. So when we're donating, most people think of just donating cash. So they don't think of donating directly from their IRA. They don't think of these other stocks that they're holding that have considerable gains in them that they could also be giving away. And so one of the beautiful things is that you don't have to give cash to these charities. You can give stock. And so by donating stock, you get kind of a double tax benefit. Because let's say you own a stock, you sell that stock and you pay a tax on the capital gain. And then you gift, but after you sold, so you have to pay the tax. Now you gift that. And let's pretend that you even get a charitable benefit for giving that. We only got one charitable benefit in the gift. What if instead of selling the stock first and donating the money, you just donated the stock? What happens? Well, number one, you avoid the realization of the capital gain. So you're gifting, you have no tax on the appreciation when you donate directly. Well, what about the charity? Well, the charity, when they sell it, they're a nonprofit, 501(c)(3). They're not going to pay the tax on the gain either. So nobody is going to pay the tax on the capital gains. Number two, as long as it's a long term, meaning you've held the asset for more than 1 year, you get the deduction of the entire full market value of the donation. And then number three, you're able to just give more to the charity because now 100% of that goes to the charity and not, you're not netting anything out for for taxes. So Ian, why don't you like run through this kind of brief example and add anything that you wanted to discuss?
Yeah, one thing I want to differentiate is you kind of mentioned it, alluded to it. This is for non-IRA, what's called non-qualified accounts. So this has nothing to do with IRAs. Those are qualified charitable distributions. That's their own thing. Now, if you don't have an IRA and you have just a regular brokerage account and you have some appreciated securities in there, appreciated stock, and you want to donate that and see what kind of tax savings, this strategy is for you. So Justin kind of ran through some of the ideas. You avoid the capital gains, you get the full market value to be able to deduct from your taxes, and 100% of the value is going to go to the charity instead of the amount that's being taken out for long-term capital gains, going to the government. All of it's going to go to the charity. Now, one important thing to note in two, that full market value being deducted from the entire value, that has to be at a long-term holding, which means 12 months or more, so a year or more. You have to be holding the security, and it's got to be a long-term gain to receive that full market value as a deduction. Now, if you have a short-term gain, say you purchase a stock for $100, it goes up to 150 within 11 months, and you want to gift that stock, you're going to receive an amount that you can deduct, but it's only going to be the amount that you use to purchase the stock. You're only going to be able to deduct $100, not the full 150. So it has to be a long-term capital gain if you want to get the full market value for a deduction. Now, in this example, Lisa, she's donating $10,000 of stock, and she bought it for $4,000. Now she's going to get a $10,000 deduction because this is a long term. She held it for the long term over a year, and she's going to avoid roughly $1,200 in capital gains taxes, and that's going to save about $3,600 total compared to just donating the cash.
And let's say in that scenario that Lisa likes that stock. And so she wants to still have the stock, but why would she gift it away if she still wants the stock? Well, she initially bought that stock for 4,000. It's now worth 10. She can gift away the stock for the full 10,000. And then with $10,000 of cash out of her pocket, go repurchase that stock. Now, why would she do that? Well, now her tax basis in that stock is no longer 4,000. She's gifted that away. Her new tax basis is 10,000. And so if in the future that grows to, let's say, 12,000, she sells it, she's only going to have the capital gain on the $2,000 of growth at that point in time, versus if she just gave away 10,000, held this stock, and then eventually sold it at a much larger gain in the future. And so that you can still do this. Now, we did get a question in just now. Is this just for stocks, not shares of other things? No, it could be shares of other things. So mutual funds, you can gift, other ETFs, from Vanguard, BlackRock, anything like that. So you can gift, and it's not just stocks either. It could be real estate. It could be other appreciated assets. So there's a lot of different things that you can gift at, and get the benefit of, the full market value. David, anything else you'd like to add here?
So two things. One, another thing that you can donate is cryptocurrency. Anybody who's holding Bitcoin that they bought at a low price and it's now at a high price, that's another thing you can donate. But I'll show you how powerful it is. I bet you we've already convinced everybody on the webinar of how powerful this is. Now I'm going to use an example. I told you before, think about small donations. Now I'm going to talk about the biggest donation you ever heard of. Yesterday, Michael and Susan Dell announced that they were donating $6.2 billion. Okay, we can't do a show of hands because it's a webinar, but how many people think they wrote a check for $6.2 billion? How many people think that they donated 6.2 billion of Dell's stock? All right. Have I convinced everybody how powerful this can be? Now, we're not donating, you're not likely to donate $6.2 billion, but maybe you're interested in donating $620, maybe even $6,200. Why can't you use the same technique?
Yeah, absolutely.
Yep. And Justin, one more thing to kind of add to that question. If it's just stock, you can donate or various other things. One important thing to note is to make sure that the charity that you want to donate to is able to handle this kind of donation. Now, many big charities, think like St. Jude, Wounded Warriors, yeah, they probably have the infrastructure in place to be able to accept that kind of gift, and there shouldn't be much issue, and they should be able to give you, a lot of direction. But what happens if it's a small local charity, your local church, your local food bank, and you come to them and ask, "Oh, I want to donate some stock. How should that be processed. What should I do? They might say, ooh, we don't have that kind of infrastructure in place. We usually just accept cash donations. Well, what do you do at that point?
Take it away, Ian. What do we
All
do?
right.
Go to the next slide. That's what you do. Go to the
Yes,
next
we're going to go
slide.
to the next slide. And this is to discuss a donor advised fund. So, your charitable savings account. So, a donor advised fund really lets you contribute whatever it is, the appreciated stock, cash. It lets you contribute now at your convenience, whatever it is that you want to contribute for an immediate deduction in this current tax year. And then you could recommend the different donations to charity over time at your convenience. Now, it's really perfect for bunching donations. Now, what is bunching donations? So, say you want to give $5,000 a year to your local church. That's normally what you donate, and you want to continue doing that into the future. Well, if this year you just sold your house or sold your business and you have a relatively high, you're going to be in a relatively high tax bracket. Well, what if you were to bunch those donations all into one year? It doesn't mean you have to donate to the church all this year, but what if you could get that deduction this year and then over time still donate that $5,000? Well, that's what the donor advised fund lets you do. So you're able to donate whatever amount that it is that you want to. It's going to be over a select period of time. You get that immediate tax deduction when you fund the account. Now, even though you're not going to donate everything in that specific year, you could still invest the funds tax-free while you're still deciding where to give. And you don't have to come up with the decision of where to donate it, when you put it in. It's not like, oh, this donor advised fund is specifically for my church and that's it. And then, maybe 2 years down the road, oh, there's another charity I want to give to. You can still absolutely do that. You can still absolutely give to a different charity. You can decide that you have that flexibility. It also simplifies it because you're just getting one annual receipt. Everything's coming out of the donor advised fund. It's not like you have to go to every single charity and make sure that they're giving you a receipt for it. It's coming out of the donor advised fund, so it's a charitable donation. And it also allows you kind of to involve other people, family members, close friends in the charitable decisions because over time you have that flexibility of knowing, when you're going to donate it. But bunching that gets you that immediate deduction in the first tax year. So a good example, I like to use numbers. So in the bottom left, if we're looking at a two times donation bunching, so say that same $5,000 figure, you're going to give $5,000 a year to a specific charity. So combining it into one year, you put $10,000 into the donor advised fund. Doesn't mean that it's all going to go to the charity that year, but say you're taking the standard deduction and it's $35,000 is the standard deduction. That's not the number, that's just a simplification. So putting 10,000 in the donor advised fund, your itemized deduction is actually going to be 40,000 if you include your different real estate taxes, state and local taxes, different mortgage interest. If you all that adds up to 30,000, and then you have a $10,000 donation that you're putting in the donor advised fund that goes up to 40,000. Well, hey, in that year, you're actually going to be getting more than the standard deduction. And then the next year and years after, or in the next year, you can take that standard deduction, 35,000. Great. And then the next year you could bunch again, put another $10,000 in that you're going to do for the next 2 years. And so you're getting more in deductions than you would if you were just itemizing or if you were just taking the standard deduction. Anything else, Dave, Justin, to add there?
I'll jump on the bunching bandwagon here for a moment and take us out of cash assets. Because all of these examples that we're giving, and I know we're going to change the topic in a moment, are cash assets. But what if you want to donate a non-cash asset? Okay. You think about clothing, you think about cars, think about real estate. This idea of bunching becomes real important because you can, if it's a non-cash item, you can only get a tax deduction if you actually itemize. So if I know I'm going to make a non-cash contribution of some significance, I've got to clear that threshold of the standard deduction. Otherwise, I'm still going to be better off taking the standard deduction than getting a tax deduction for my charitable gift. So combining non-cash and cash donations in the same year for bunching purposes is also an effective strategy.
Yep. Excellent. Great point. All right, so those are the last couple things that we're talking about. Most people, can and would take advantage of. Now we're going to shift gears into a little bit more of some, more advanced charitable planning, where the average person is not going to take advantage of these in most years. Now, there may be some year where you eventually, if you own a business and you sell the business and you've got a large, income, or you've got, many, many assets and you want to gift that to the next generation more tax favorably, this is where some type of charitable trust planning comes into place. And this is like an oversimplification. And so this is where you would bring in an estate planning attorney along with a financial planner, along with potentially an accountant, getting the full team on board if you're going to do something like this. This is just to kind of give you a snapshot of the ideas that you can implement. So the two main trusts when it comes from a charitable perspective is a charitable remainder trust and a charitable lead trust. The difference is when the charities actually get the money. So typically speaking, on a charitable remainder trust, that's going to be utilized where you want to give the money to charity eventually, but you might need income for yourself over the next several years before you can give that money away. But you have a really high income in this year that you want to be able to offset and get a charitable deduction for. And that's where the charitable remainder trust works very, very well. So you can have this huge asset that you would then put into the charitable remainder trust to basically, get an upfront charitable deduction, eliminate capital, gains taxes on the sale of that asset, reduce your taxable estate as well, but not gift that money in its entirety. Say, all right, I'm gifting this money, the remainder of it's going to go to charity, but over the next several years, I'm going to get an income from this charity because most people can't afford to gift their life savings and not have some type of income there. And so that's where the charitable remainder trust could become a potential. A charitable lead trust, we haven't really seen this a lot with the estate tax exemption being so high, and it got even higher with the One Big Beautiful Bill Act. It's sitting at around $15 million-ish or so per person. But this could be utilized, for example, as an example, if you're above that, to say, all right, I want my next generation to get these assets, and I want to gift it to them, but I don't necessarily want them to pay a huge tax on that gift. Well, a charitable lead trust could do just that by putting the money in and gifting it away, kind of potentially zeroing out that taxable gift, having the charity get the money over time. So the charity receives the income first, and then after some set period of time, then the remainder is gifted to the family to transfer to the next generation. David, anything specific you want to add from a trust perspective?
Yeah, so where we've seen these be used most effectively is with real estate. So let me use an example of a shore property, beachfront property, and let's use charitable remainder trust. Okay, your family, you decide your kids have no desire to inherit this property on the shore. Either they got their own, they got something else, they're too far away, they can't use that property, and you decide that ultimately, if I leave this property to the kids in the will, all they're going to do is turn around and sell it. Maybe they don't need that income because you have other resources. By using a charitable remainder trust, you could donate that property to the charity and get your tax break today, lowering the cost of maintaining that property until you get that lifetime income now, so that you've turned that into something that's beneficial to you and beneficial to the charity. So the kids who didn't want that property anyway will do without. So a lot of times when you see real estate, because it's a big number, a lot of times you can see these trusts come into play because it's easier to change the deed on a piece of property and get your tax break rather than to leave it to somebody who may not want that. You could even do this with your own personal residence, although it's less likely that you will do it with your personal residence. But real estate makes a really good way to utilize these trusts.
Great points. All right, so let's kind of talk about the legacy planning, and I call this the who gets what conversation. And this is after you're gone, and typically, it's very common for people to leave assets or charitable gifts in their will, as an example, 5,000 to this charity, 10,000 to the church or whatever. However, that's from a tax perspective, typically not the most optimal way to give it. So let's say you do have an IRA, let's say you do have cash or stocks or anything. Well, the problem is when individuals inherit IRAs, they're going to owe tax on that. And not only are they going to owe tax with the new rules, they have to distribute that IRA with over 10 years. And so that can, force a lot of income onto them in years where they may not want that income and push them into an even higher bracket. The solution now is charities. They don't pay taxes. And so we're not talking about qualified charitable distributions here, which you could do while you're alive if you're over 70 and a half. But what you could do is name as a beneficiary on the IRA a charity. You don't have to do 100%. You could do 10%, 15%, any percentage that you want. But if you leave the charity as the beneficiary of the IRA and leave the other assets to your family, what happens? Well, the result, the charity is going to receive that IRA and they're not going to owe any taxes on that money. Now, your family, for these other assets, let's say it's appreciated stock, they receive what's called a step up in basis. And so they have a stock that if you would have sold it, you would have had to pay a bunch of capital gains on it. Well, when you pass away and your family receives that stock, their basis is the fair market value when you passed away. And so they sell it, they don't owe any taxes on that sale versus leaving it through your will, like of $5,000, $10,000 cash. That cash would have gone to your family tax free. It still goes to the charity tax, tax free as well. But now your family's inheriting $10,000 less here, and they're going to have to pay, the full brunt of the taxes from the IRA that they're inheriting from you. So Ian, do you want to go through that kind of example here?
Yeah, let's go. So John and Mary, they have an IRA and they also have some other investments in stocks, and they're gonna leave 500,000. They want to leave some monies to their son. They also want to leave some money to charity. So they're gonna redirect that $500,000 to the charity. They're going to have the charity as the beneficiary, and then they're going to leave the $500,000 that they have in stocks to their son. Now, this is a pretty simple example. It's never exactly 500,000 split each way, but for simplistic circumstance, that's what it is. So their son is going to receive that full $500,000 tax-free because there's that step up in basis. So whatever the amount that they paid to purchase that stock, it doesn't matter. At the date of their death, that cost basis is going to move up to the $500,000, that step up in basis. And if their son is to take it out immediately, after that step up in basis, he's going to get that tax free. Versus if it was in the IRA and he had to pay tax on all those distributions, he would only get $340,000 after tax from the IRA. And the charity doesn't matter. Similar to a qualified charitable distribution, they don't have to pay tax on the distributions from that IRA. So they're going to get the full $500,000 instead of $0. So that's $160,000 more going to where they wanted. So they're getting the full $1 million that they have. That's going to the areas that they want instead of less going to each cause.
Yep. So if you have different assets, make sure the beneficiaries are aligned up for that because each asset has different tax ramifications, based on, who receives that asset. David, anything else to add here?
No, I was going to say the exact same thing, that not every asset is worth the same to the beneficiary. So you do want to figure out, and in fact, the title of our presentation today is Planned Giving. Okay. When we're talking about these larger numbers, it's not spur of the moment. You actually stop and think and say, these assets are worth different amounts. And by the way, even if this is not the topic today, but if you have 3 kids, let's do 4 kids. If you have 4 kids, and they're in different tax brackets, some of them, the IRA money is worth more than the other kids. You may want to decide that the IRA goes to 2 of the kids and the stock goes to 2 of the other kids. And if the example is not exactly 500 and 500, it becomes a little bit easier because you can give 600 of the taxable IRA to the kids in the smaller tax bracket and 400 of the stock to the kids in the higher tax bracket, and the kids all end up the same, but the government ends up with less, which is how the government ends up with the deficit. Well, that and a
Yeah,
few other things.
just that.
Well,
Yeah.
yeah. One more thing, Justin, I wanted to discuss from that last slide, if you can
Yeah.
go back real quick. Because a lot of times people have on their will, they have a bequest of a certain amount of money to a specific charity that they're really passionate about. And on their IRAs, they have named beneficiaries, whether it's their children, whoever, not the charity on their IRA. Well, doing that is pretty much the same thing as doing the opposite of that example. So it's not as tax efficient to do that. Now, this is just really a reminder. Maybe check your wills, make sure any charities that you're donating to, perhaps it might make sense to list them as a beneficiary on your IRA to a certain percentage.
Great point.
Great idea.
So obviously with, charitable contributions, there's different rules that we want to, you make sure to follow. Like for example, when we're talking about number 2 on the slide, appreciated assets, if you're going to gift a very large amount in 1 year, you can only deduct up to 30% of your adjusted gross income. So if relatively speaking to your income, you're donating a very, very high amount, you may not be able to get the full benefit of the charitable deductions in that year. Now, the good news is it doesn't just go away. You can carry forward that over the next 5 years, but it is something to keep in mind there. Cash gifts, you can deduct up to 60% of your adjusted gross income annually, and that was made permanent for 2026 and beyond. You want to make sure, as we were talking through it, if you're going to gift just from cash or from something, if you need to get a written acknowledgement from the charity for any donation of $250 or more, and appraisals also are important for non-cash gifts over 5,000, except if it's a publicly traded stock. I mean, you pretty much have a record of what that stock is worth. There's an agreed upon amount there. But anything else, like real estate or something else, you have to make sure to have an appraisal and not to just make up a number to say, I think it's worth this. Like you need to have some backing of, why you have this, are saying it's worth what it is. And so if you don't have that, then it could be questioned later on. So even if you do all the right things, if you don't have that proper documentation, the IRS can just say, yeah, no, we're not even going to allow that. So you have to keep these acknowledgement letters, receipts, just in case the IRS comes and says, did you really make that donation? Prove it to us. David, Ian, anything you'd like to add on this slide?
No.
All right, awesome. So I wanted to highlight something that we Personal Wealth Strategies are doing from a charitable perspective. And there's other things that we're doing, and we do some of those stuff behind the scenes. As an example, around Thanksgiving time, we gift to Feeding America on behalf of our clients. We also do some internal giving as well with our team to decide, which charities to support each year. But this is something interesting, a new opportunity this year, and we're going to break a Guinness World Record for the world's largest toy drive. And with this, I'm partnering with Sean Callaghy, Dan Fleischman. Sean, he's on the verge of becoming the first blind self-funded unicorn founder in history. His new podcast recently hit #1 in the business category on Apple. Dan, he's the youngest founder of a publicly traded company in history as well. So we're all teaming together, and specifically on December 21st, which is a Sunday, we are going to the American Dream Mall in North New Jersey. And we're going to be filling that mall with 119,000 plus toys. So not only are we breaking the Guinness World Record as a whole between all of the locations, but specifically in one location, the American Dream Mall, the most toys collected. And so, we're already going to break it. So if you want to be part of the story and that, you feel connected to, gifting toys from if you own a business, a PR perspective, you feel free to reach out. You can email me. You can text Toy Drive to our number 609-586-9308, and we can get you the information if you want to, be involved, not just from a monetary donation standpoint, but also boots on the ground at the American Dream Mall. We can help coordinate all of that. So let's just kind of put this all in a nice bow, round out, and any final questions, feel free to drop those in the Q&A chat. But the key is, as David has been saying the entire time, like this is planned giving where we sit down and we take a look. And so the first thing to do is to assess your situation. What are those charitable goals? What's your age? Because that depends on if you have qualified charitable distributions at your disposal. Where's your income sources coming from? What types of assets do you own? Consider if you're taking an itemized or a standard deduction, what your income looks like. So all these different factors could change the strategy depending on, what is your priority and what are your different sources of income. So then you kind of review your overall situation. Then you can choose your strategy. So age 70 and a half, that opens up those QCDs, qualified charitable distributions. If you have appreciated stock, then you can look at, donating that. If you want to easily bunch donations without gifting it, directly to the charity, you can open a donor advised fund. If you're planning for your ultimate estate, potentially you'll want to redirect those IRAs to charity. So those are just a handful of strategies that you can consider depending on your situation. And then, yes, you can do this on your own. You can watch, one 50-minute webinar and decide that you're an expert in charitable gift planning. I don't think that's going to be the case, but you could try that. Or you could work with your professionals. You can get a financial planner on board, a tax advisor, an estate planning attorney, and then, pull all these professionals together to make sure that you're taking advantage of, all of the charitable tax benefits that you can, and maximizing what you give to yourself and your family. And as David mentioned before, most charities, you can also utilize them as an additional resource as well. If you have a particular charity you want to support, most of them have planned giving departments that you can loop in and help to give advice on this. So the bottom line here from me, and then I'll open it up final to David and Ian and answer any final questions, is this isn't about loopholes. It's just about sitting down and smart planning to maximize your dollars. So to the extent that you don't have a plan, Uncle Sam has a plan to take most of your money. But if you have a plan, you can direct it to the people that you care, people and charities that you care most about. And so by using the strategies, you support the causes that you care about, keep more money in your pocket. So it's truly, as David started the presentation, I'll end the presentation, do well by doing good. David, Ian, any finals from you?
No, just to kind of piggyback, and I know we spoke about it earlier, but these tax planning, these strategies for giving, you don't have to see it as, oh, you're saving money from your donations. You're actually just you have more money to donate to the cause that you want to. So it's either the charity that you want to donate to is going to get more, or the government's going to get more. If you want to donate money to the government, that's perfectly fine. They will accept it. But if there's a way to take it from the government's hands and taxes to your charity, that's what these strategies are all about.
Yeah, and I'll close with this thought, Justin, and perhaps we maybe should have opened with this thought. Sometimes when it comes to charitable giving, people think that there's enough loopholes that they can actually give monies to charity and end up making a profit on the deal. That's not the case. If you notice in all these situations, we're getting tax advantages, we're not making a profit. So it's got to start with philanthropy, and you got to want to give of yourself to help others. But when you decide that you want to do well by doing good, it is wise to consult with professionals who can tell you the most efficient way to do that. You wouldn't want to take a trip from New Jersey to Los Angeles by starting to walk. Somebody would say you might want to think about taking a plane, a car, or a train. Okay? You don't want to start by making larger donations by getting out your checkbook and just writing a check. There is what we call impulse giving. That's the stuff that takes place when you see a commercial and there's a little puppy on the screen and teardrop goes down and you say, let me get my checkbook out and send in the check. That's fine. All right. Maybe it's not as good as using a qualified charitable distribution where you can get a little tax advantage on that. But look, we all do that. We all give to the Girl Scouts when they're selling cookies. We all do that kinds of things. But planned giving is all about stopping before you write the check and say, what's the most efficient way to do it? And I'll leave you with this thought, Justin. I use this example that if we were going to buy a new TV and we're getting in the car to go to Best Buy and we found a coupon with Black Friday, I'm sorry, we saw a TV on sale for $100. And we said, this is too good to be true. I got to go to Best Buy and buy this TV for $100. get in the car and you're halfway down the street and say, oh, I forgot. I have a coupon on the kitchen table for $22 off at Best Buy. Would you turn around the car and drive back for that coupon for $22? I know I would. And my wife will verify that I would. I'd go back for that coupon. Well, if you're going to donate $100 to a charity and you could take advantage of being in a 22% tax bracket, that is a $22 off coupon for your $100 donation. And if you turn around the car to get a coupon for Best Buy, stop and say, I can't remember what Justin, Ian, and David talked about on that seminar. It was too much. I just remember there was a way that I can take advantage of making a charitable donation, getting a tax break. Let me call them up and say, explain that to me again. How do I do that?
Yeah. Beautiful. And it doesn't look like we have any more questions, but we do have a comment. It says, thanks for all you're doing here. Much appreciated. And we appreciate you. Thank you so much for coming out today. And if you have any questions, whether you're a client, just seeing this for the first time, feel free to reach out to us and we'll point you in the right direction. But when it comes to your charitable giving, we want to be, generous, be hopeful, and have a great holiday season for everyone out there. We appreciate you attending our final webinar here of 2025 and hope everybody has a safe and healthy holiday season and Happy New Year.